Welcome to the Agent of Wealth podcast with Mark Bautis from Bautis Financial. In this podcast, Mark helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Mark draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth podcast. This is your co-host, John Williams, and today we're going to be diving into the topic of investment fees. There's a lot of confusion around this topic, and there are a bunch of different ways that you could potentially be paying investment fees. So today I want to give our listeners a little bit of an idea of what those different types of fees are, how to find them, and potentially find out what you are actually paying if you're unclear as to what you could potentially be paying in investment fees. And then once you know those numbers, how you might be able to assess whether or not it makes sense for you to continue to pay them and just understand where the value might be coming from that's connected with those fees. We found a recent study from FINRA that says nearly 73% of investors didn't know exactly how much they paid in investment-related fees. And even 21% of investors believed they weren't paying any fees at all. You're almost always paying something, which you'll understand here a little bit in a minute. So when we start working with new clients or even just current clients or just have conversations with investors, it becomes really, really clear that there is a big gap between what they potentially could be paying and what they understand they're paying. I think that it's really obviously really important. I think the way I look at fees is there's nothing inherently wrong with fees. Obviously, as an investor, if we're managing your money, you want us to get paid for what we're doing. But I think understanding what you're paying and weighing that against the value you feel like you're getting is really important, and really important really for me to make sure that our clients, potential new clients and current clients, understand what they're paying and have the opportunity to see and weigh the value we're bringing to them and understanding that value is going to be worth their while. So I want to start with breaking down the different types of some investment fees. There's going to be three main categories. The first is expense ratios, the second is advisory fees, and the third is trading costs. Expense ratios is really going to be the one fee that is going to run across all different advisors or all different platforms, whether you're managing your investments yourself, whether you're working with an advisor. Expense ratios that are tied to an ETF or a mutual fund is going to be the same no matter where you go. That's regardless of the custodian you could be using. So even if you don't have a Vanguard fund that you hold in an account you have at Schwab, regardless of where that, in this example, that Vanguard fund is held, the expense ratio is going to be the same. Expense ratio is essentially at the highest level going to be a fee that's connected with that company. In this example, again, Vanguard. The expense ratio is for them to essentially keep the lights on, pay their employees, pay the advisors that are, really just it's their way of making money, for the lack of a better word. There can be a pretty wide range of what these expense ratios can be. They can run anywhere from 0.05 up to 2%. Why there's such a wide range is it really depends on the amount of management that goes into a fund, the amount of time and how many managers are actually managing that fund or that ETF. Just to give you an example, if you have an ETF that is, let's say, the S&P 500, an index ETF, there's not a lot of active management that's going into that ETF because it's really just their job to make sure that that ETF emulates the actual S&P 500. So on a day-to-day basis, they need to make sure that whatever's in that fund is actually going to mimic the S&P 500. Contrast that with an actively managed fund, which might be a fund that, let's just say for simplicity's sake, and in an example, you have a bunch of fund managers or ETF managers that want to try to beat the S&P 500, and they're going to do more research and they're going to potentially do more work to try and build this fund. So in that instance, you might see a higher expense ratio. In these two examples, of course, you would expect that, and I'm sure it makes sense to you, that the ETF that's going to basically simulate the S&P 500, it is what it is, right? There's not a whole lot of decisions to be made. There's not a whole lot of work to be made. So you would expect the expense ratio to be low in that instance. With that said, that doesn't mean that there's anything wrong with paying a higher expense ratio for a potentially actively managed ETF or mutual fund. But, you want to make sure that the juice is worth the squeeze. Really just look at that performance versus the expense ratio, because one of the things you don't want to do is get so hung up on the fact that you're paying an expense ratio, but if it's extremely worth it, fun as far as performance is concerned. So there's this constant balance and weighing of, okay, do I need to be paying this? And as a fiduciary advisor, there's a lot of choices out there. And if there are, as an example, a lot of choices within, say we're looking for exposure to technology, and say there's a fund that's going to be focused on technology, there could be dozens of different funds, ETFs that are out there that are focused on technology. We're going to look within that and potentially looking at the lowest expense ratio within those choices to make sure that we're keeping the expense ratio low. And what that really means is like, say I want a technology fund and I feel like fund A and fund B are doing the exact same thing, and all things being equal, I'll just pick the one that has the lowest expense ratio. The long and the short of it is the expense ratio is basically going to be what the fund managers are going to need to make to keep the lights on and basically make their profit and run their business. The second type of fee is an advisory fee. We're a fee-only advisory firm. Advisory fees can run, as you can imagine, there's a gamut and a wide range of different fee amounts, depending on how much work that advisor needs to do for you and what they're going to be doing for you. The industry average is about 1% of the assets under management. So if he or she is managing $100,000 and the fee is 1% per year, throughout the year you pay about $1,000 for their services to manage and do all the other services they're doing for you. So this also, I think, they call it advisory fees, but I think I also, because we do a lot of financial planning with the investment management. So I almost call it advisory fees and financial planning fees. Everyone's different as to what they want to achieve with us. So for instance, if you're somebody who likes to manage your assets yourself and just wants somebody to help you with the financial planning, there are ways for us to have advisory fees that are just geared towards the financial planning. Most of our clients are going to be looking to us to manage their investments and the financial planning. So that one advisory fee covers all of our services. So it just really depends on the engagement. And then finally, there is commissions or trading fees, trading costs. The difference here is the advisor and who they're working for. When you first started working with the advisor, if the advisor was receiving commissions, he's really required to tell you, hey, this is the way that the commissions would be set up. And the way the commissions typically work is there's going to be a percentage of the amount of a particular mutual fund or ETF that you purchased that would then go and be set aside for commission for their services. By a $100,000 mutual fund, there could potentially be, say a 5% initial commission on that sale, and they can be structured different ways. Sometimes what they call like front load, back end, there's like ways that the commissions can be spread out over a certain period of time. And I'm not going to go into the exact details there, but just let it be known that like it's based off of trade. So every time there's a trade being made, that's the way that the commission is going to be set up. To make things even more complicated, you can be working with an advisor where there's advisor fees, which I already mentioned, and trading costs and commissions. I'll get into a minute about how potentially you could find out if you're confused as to what you are paying, how to figure that out. But just in review, expense ratios, paying a percentage for that mutual fund. So if you're paying an advisor fees or a commission, that expense ratio is going to be the same regardless. There's no way around the expense ratio, and it's going to be the same. It's not going to change from institution to institution, from advisor to advisor. And then like these advisor fees and these commissions are almost like on top of the expense ratios. With that said, you want to make sure that you're understanding what those expense ratios are and what the advisor is doing to make sure that he minimizes those expense ratios for you to keep your investment. Because that advisor and many times have a fiduciary responsibility to make sure that they keep those as low as possible for you. So now we have an understanding of what the different types of fees are. How can we find out what we could potentially be paying? Now, if you're working with an advisor, I would just start by saying, or just start by asking. If you've been working with them for a while, maybe it's just been a while since you've had this conversation, you've been working them, natural that time goes by and you just don't remember. Maybe the next time you have a meeting with them, you sit down and say, hey, can you just go over what my fees are and what that involves? If you have a statement and do you want to know if you're paying an advisory fee, the way that the advisory fee comes out could be quarterly, could be monthly, but just check some of your statements. As an example, we actually we put our advisory fees in every quarter. So if you looked at a monthly statement and it wasn't a quarterly statement, you wouldn't see that advisor fee. So just be aware that you need to check multiple statements, especially a quarterly statement and a monthly statement. If you scroll through your statement, you should find a place where there's activity or transactions, so on and so forth. And through there, you will see what would be like a management fee, advisor management fee. A lot of times it's not going to tell you what the percentage is, but you could then look at if it was a quarterly management fee, you could look at roughly what the amount is, the value of that account that it's being billed to, and do some math. If you're doing it at your DIY, chances are maybe you're not even paying any of these advisor fees. If you're just managing these, you're building your portfolios on your own, there's a good chance you are not paying a fee. And if you are doing everything on your own, you want to make sure that you're not paying a fee and not know it. Commissions will be very similar. They're only connected to transactions. So if you work with a broker dealer, an advisor that works with a broker dealer, and you picked up a mutual fund for, let's say, $100,000, but it was like 2 or 3 years ago, and you hadn't made any trades, you might not see the commission, especially if it was front loaded. So maybe just go back to that advisor who sold you those and just have them explain how the commissions were set up. But if you did recently see a trade, or you made a rebalance in your portfolio, or you made some changes, that's a good time to then look and see when those transactions occurred. There should be in your statement somewhere what the commissions were. And then also, like I mentioned, keep in mind that there could be advisor fees and commissions. So just keep an eye out for that. As far as the expense ratios are concerned, sometimes the statement shows what the expense ratios are, but very easy to find out what the expense ratios are on each of your mutual funds or ETFs. You do a quick Google search. So if you have ABC Fund, you can just look up ABC Fund online, and in the information you find, you'll see pretty high up on that information list, you'll see an expense ratio. If you sift through, the chances are you'll be able to find that. If you want help finding out what your fees are, or you want us to look at a statement, I'd be happy to take a look. I mean, just make it easier for you. Just set up a call with us. I'd be happy to look at those and have a conversation around what those are, and shed a little bit more light on this. But once you get to that point where now, of course, back to what I was saying about how I feel like fees, to me, in most cases, I'm happy to pay a fee, even if it's something that I feel like I can do myself. I use the example of mowing my lawn or changing the oil in my car. I can do both of those things, and actually, I did for a minute. I actually didn't mind mowing my lawn for a while, but after a while, you're just kind of like, all right, this is not a good use of my time. And that's really what it comes down to is working with an advisor is not necessarily all about performance, but there is, of course, you want to make sure that advisor is getting the performance for you that you expect. But there is a subjective part of this that allows people to find someone they trust and do this work for them, because one, they don't want to do the work and they don't have the time, and they just respect the fact that an advisor that's been working in the business for 20 years is probably going to do a better job no matter how hard they work on the weekend to try and manage their portfolio. And there is value that comes with that. I always say to clients who first start working with us, I don't want you working with me unless you see the value on what you're paying. It's just the truth. So it's my job to show you that value for what you're getting. And a lot of that is hey, you're a busy person. Go spend the time with your family, your kids, go work on your career, all those things that are important to you, and let us handle these things. So there's that part of it, but there's also the performance part of it. And there's also what that advisor is going to do for you. And the perfect example really is back in the 80s and 90s, there was really just investment management. There's been this popularity of financial planning has grown quite a bit. And that has brought a whole nother level of it being an advisor, where you had before, like if you have an advisor who's just doing their investment management for you. So they're making sure your portfolio is set properly. There's that. And then there's the potential that that advisor is not just doing investment management, but also helping with your estate planning, helping you with potentially if there's issues with some insurance and risk management. Tax planning is a really, really big one, which we focus on a lot, is helping you save on taxes. Now, there's nothing wrong with an advisor who just does the investment planning and doesn't do the financial planning, but you need to understand the difference between an advisor who is doing a really great job for you with investment planning, but also doing covering all these other areas. We call it almost like a CFO of your family finances. And we make sure that we're covering all those different areas. Just as an example, if you compare an advisor who's doing investment management for you, looking at what their fee could be potentially against an advisor doing investment management and then all these other services, you'd like to think that there'd be a little bit more that you'd be paying the advisor for the financial planning and the investment management than just the investment management. But just it's not always cut and dry. I just want to give you an idea of what potentially they could be doing. And I see it a lot where I see an advisor or a client that potentially could be working with an advisor right now is paying 1% and a 1% AUM fee, and all they're getting is investment management. Where they come to us and we actually are also offering 1%, but we do investment management, tax planning, financial planning, full financial planning engagement. It's really just where we try to add that value. And we work best with those who see that and understand that and want the financial planning and want the whole suite and want somebody they can trust and really just do everything from top to bottom for them. As you're listening to this, I think you can kind of make an assessment as to, okay, that makes sense for me. Or maybe you can just go back to your advisor and just have them explain to you, hey, this is what your fee is. This is what you're getting for that fee. So you can then now do an analysis. Okay, all right, I know what I'm paying. I know what I'm getting. And now weigh that value to potential clients and clients. Hey, if you get to a certain point where you see those fees that you're paying us and you want to have a conversation around it, please let me know, because I always want those that I'm working with to see the multiple of what they're paying us. So if they're paying us 1%, I want them to see the value of upwards 3 to 4% a year based off of what we're giving them. It should, in my opinion, should be a multiple of what you're actually paying, whether it be through investment management, tax savings, and just that subjective part of the engagement, which is just saving you a ton of time and peace of mind that you have somebody that you trust, that you've built trust with to take care of some of these things. So hopefully this was helpful and shed some light on this fairly complicated subject here. If you have any questions or want to have a conversation about fees, this or anything else, you could set up a call with us, a free call at bautisfinancial.com/call. Again, that's BAUTIS financial.com/call. You should see that in a way for you to click and just get through to that, setting up that call here in the show notes. Yeah, thanks for joining me today, and until next time, talk soon.
Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.